Hey everybody, good afternoon. This is Doc Severson with 12 Minute Trading. I'm joined by Dave Lukas of 12 Minute Trading as well too. Today is Monday. It's Monday the 5th of February as we get into a new month here, and we have a market that's kind of transitioning into volatility. I think a lot of people were surprised by Friday's unbelievable move to the upside at the top of an 800-point flagpole that we've already printed since last October. It just doesn't seem to go anywhere. This is why we use the bobber in today's thumbnail, because you just push it down and it just bobs right back up again. But we're wondering, Dave and I were talking here a little bit offline, and we're wondering how long is this game of musical chairs going to go? So, Dave, welcome aboard. What are you seeing in the markets today?
Well, to answer that question, the game usually always goes longer than anybody thinks it will. So we got to keep that in perspective. But Friday, Thursday was a textbook Fed reversal day. So that was, always look at the day after the Fed, because that really, shows you what the real move is going to be. And then we got that follow on into Friday. So now the market's got to make a decision, right? We've got, we have Powell come out. He did it again this weekend. He was on 60 Minutes, and no hike no rate cut going to happen in March. And if you look at the Fed funds futures, look at the radical shift from having 5 or 6 cuts. Now we're down to 4, and then the chances of a March cut are now at like 14%. So all of this is radically changing, and we've got a lot of divergences happening in the market. And I remarked and showed some of my students this in my newsletter over the weekend when I was analyzing the markets and going through and really talking through them. And there's some things happening that I think are interesting signs, right? So we've definitely have some serious euphoria in stocks like NVIDIA and everything else running up into earnings. I mean, they're parabolic, going straight up and that sort of thing. But we've got these kind of big divergences happening right here. Advancers, decliners, that's changing. The number of stocks that are, that are getting below the 200-day, that type of thing is, more stocks are going below than going above. And so you've got the dollar heading higher. You've got the 10-year that's way back up over 4. In fact, it was up over 10 basis points earlier today that I saw. And so you've got a lot of these kind of divergences starting to happen. And I know, Doc, you talked a little bit about this in your weekend update, but the other thing that I'm seeing is some really smart people that I respect in the markets that have been very bullish going defensive. Good examples like JC Peretz All-Star Charts. He called the bull. He called it all the way over a year ago. He's been out front of it. He's been on Fox News arguing with Maria on Mornings with Maria about we're in a bull market. And just the end of last week, he came out and said, look, here's the divergences. In fact, if you follow him on Twitter, you can go see he's putting out a chart like every 15 minutes. Like, here's this divergence. Here's this divergence. You can say what you want, but this is not a sign of a market that's going to continue to go higher. So he went defensive. He's buying SPX and, QQQ puts and positioning himself for it. Now, when that happens, I don't think anybody knows. If we did, we'd all be billionaires, right? Because we could take advantage of it. But for me, I've been saying that I think this February, March time is probably the time we get the corrective move. And it's just going to take some sort of catalyst. So the other thing that's happening that nobody seems to even like this would have a year or two ago been an Armageddon. China's stock market is in a absolute depression. This thing's fallen 30% in this month, the last month alone. The housing market's collapsed, second biggest economy in the world, and this thing's cratering, and nobody's really paying attention yet. I think that's going to catch up with the markets at some point. So there's just a lot of stuff that's kind of surrounding this market at this high, at this point, not to mention exhausted energies, to where something may give. And my spidey senses are up on that. And so, I've been being a little bit more defensive myself in my trades and taking things, off earlier for a profit, maybe not the full profit I normally go to, because I don't want to get stuck holding the bag when this thing does go the other way.
It's interesting because a lot of retail investors don't understand how fast things change to the downside. So what usually happens is you'll see a pop up just like what we saw on Friday, and it gets everybody leaning in the wrong direction. And then all of a sudden the trap door opens up,
Yeah.
at the gallows, and then down you go. And then, as they say, stocks will take the stairs up and the window down. So that it goes so fast, but it's not just the price. So we might drop 3, 4, 5% in the next week or two on an initial move. And then people will say, hey, what should I do to hedge now? And my stance to that is usually, well, you're kind of too late in a way, because what happens is it's not just the price, but it's also the volatility goes shooting up through the roof. You can see like a 20% spike in implied volatility. And when we're talking about a teenager VIX, it doesn't take much to get 20%. Then all of a sudden you lose your edge. You're like, hey, I bought all these puts and they're not doing anything. In fact, they're losing value. Why is that happening? And it's because we're losing our edge. So there's one little statement that I usually say: you got to be in it to win it. So you've got to be hedging your positions before you need them. If you're waiting until the move has already happened, you're already too late because you've lost that edge. So,
defense in times of peace, not war.
Oh, exactly. That's another good one. Yeah, play defense during times of peace and not war.
Well, and that's one of the reasons that you and I were talking too. I closed out a number of trades last Friday, on that, because volatility is like non-existent, and so I've had all these positions that they weren't at full profit, but man, if volatility kicked in, I'd have to sit in these things longer. That doesn't mean that they're potentially threatened or not, but it just means that all of a sudden, where it's worth this, all of a sudden that it's like air blowing up a balloon. When you get that volatility, the balloon blows up, and all of a sudden, oh crap, what was 50 cents to exit? One day, all of a sudden is $1.20, and I got to sit in the darn thing, because when we sell options, right?
Oh, yeah.
We're waiting on that premium decay. And so when you get those volatility events and those things go bigger, then you got to sit in them. Now, again, it doesn't mean that they're in trouble. It doesn't mean that they're threatened or anything, but it just means you got to stay in them. So I'm sitting there going, you know what? If I think of volatility events coming, it's another way to practice, defense in times of peace is I can clear those things, maybe not get the full profit target, but take that off the table, free up that cash, have that event happen, and then really put it to work, selling premium, getting a lot more premium at even better levels than I was even at before, and making a lot more money. For me, that makes a lot of sense in an environment like this.
Yeah, that's a great point. And as it relates to the Greeks, I mean, when I first started trading options, I heard people talking about the Greeks, and I just hear no evil, see no evil. Like, I don't want to hear about that stuff, because it sounded confusing and it sounded hard. So I sort of tuned it out. But now I understand that that's really the key to edge, because what Dave was just talking about is that your iron condor or your credit spread positions are called short vega. They want the implied volatility to go down in order for the position value to go up to you, the seller. And unfortunately, what Dave talked about is that volatility trap. Like you get this nice little stable price action, and then all of a sudden the bottom drops out, the volatility shoots straight up, you're trapped in a position you can't get out for a profit until you basically have to hold on to it through expiration, and nobody wants to do that. So it's funny you mentioned that, because the campaign diagonals that we've been trading lately are actually the opposite of that. They are long vega. And so where I have to be careful of is entering on implied volatility that's too high, which is the exact opposite. So this is where we have kind of the yin and yang of this, and we're sort of balancing off which is the better strategy depending on this. And this is what I was talking about maybe a year ago when we got into, we started to blow up to the upside, and I'm like, man, I've got to get some long vega positions on here. I've got to get some time spreads. And time spreads are always going to be long vega like that. If you buy a time spread, you're long vega. So it took literally 6 months before I found the right strategy to be able to do this. And it was just a different approach. And by the way, actually, we're talking about this tomorrow. I should change I forgot to put this into the YouTube area, but I'm speaking tomorrow at 4:00 Eastern time on the campaign diagonal tomorrow. So I'll put that
the
into
cash flow
the
strategy.
I'll put that into the YouTube video information and make sure that you guys have the registration link for that because it's free as well too.
Yep.
And by the way, if there's any questions that anybody has that's watching this live, please go ahead and shout them in. Dave and I will be here for another few minutes, and we'd love to take your questions.
Check the charts. I think it's interesting that we've been talking about these energies, and we've had these weekly energies that have been sitting at a really low level. And we look at two time frames. We look at a 9-day period and a 14-day period, and we were just comparing the two. And actually, even with the spike up, we're seeing even the 14-day start to turn for a recharge, which is really interesting, considering what we've had, over the last this peak. And the other thing too, if you look at these charts, the thing that has me on that spidey senses is like we've had moves that run like this before. In fact, if you look at last year when we finally broke out, in May and then ran all the way through July into August, we had a move that rivaled this one. The difference is that was 20 some weeks, and this has only been like 14. So the slope of this is been the wild thing, right? And that's what typically is unsustainable. You can have a nice trend that goes higher like this, goes up 1,000 points on the SPX and all of that. But to go at the slope that we're going I haven't seen anything like this in a long time. If maybe, in the last, I haven't seen it in a while, in the last 5 years. So that's kind of the thing. And the energies are interesting to watch as it has to contend with a slope like this. And some of that's even new to us. So, you can show it on your screen.
Well, I'm not. Yeah, it should be. It should be on the screen.
Yeah, you got it.
Okay. It's we talked about this a little bit last week. The last time that we saw a move that was anywhere close to this was actually back here. And that was right after the election. And 17 was just, we went through something like this in 2013. 2013 was like this, where we saw markets were actually, this is the first time I ever saw a market that would correct in slow motion and that would rally. It was the exact opposite of what we were used to. We'd see a slow motion pullback and then a huge rally, slow motion pullback, big rally like that. So all of 2013 was like writing new rules. This is why we're always so fanatically observant of what the price action is doing. And then of course, this is the blow off top of all blow off tops, was the beginning of 2018. As we took a market that was going at a certain slope, and just like what Dave talked about, all of a sudden it went into an almost infinite slope for a short period of time. And of course,
you should pull up the chart at NVDA right now and put that out there. It looks just like that.
Yeah, and the video is quite something here. All right.
Not to derail you, but it is kind of an uncanny kind of
I hope I can
deal.
spell. Yeah, look at
it
that.
reminds me of like the summer where it ran up like that and then got sold off after earnings, which is coming up. Yeah, look at that thing.
Yeah, so we had the same kind of reaction back at the latter part of 2021. 2022 took it all the way back down to $109 a share, which I'm sure what people would love to get to. But look at all the gaps. This is a good example of, people get all principled about gaps. Whoa, it hasn't filled the gap yet. Sometimes the gap doesn't matter. If you have a fundamental change in supply and demand, no one cares about your gap from, years ago and things like that. So don't get too caught up in gaps and what gaps are supposed to do. There's still gaps from 2009 that have never been filled and will never be filled probably in my lifetime, or at least if they do, I hope I'm not cognizant of them. I hope I'm drinking from a straw or something like that. If the 2009 gap is going to get filled.
I hope I'm just flat and just let it go,
right,
and then take advantage of it. That'll burst the bubble of all bubbles.
Yeah. So, also Dave and I were talking about the Russell. The Russell's been an enormous disappointment here because it looked like it was about to break out above 2,000, and that was just another one of many, many, many bull traps, but there is the potential for this to set up a bear trap, because this whole move here, if you look at this, if we go out to a weekly chart, this is potentially a lower high, beginning of a reversal to the downside. So that's a change in polarity if the 1900 level gives way. But by the same token, just like this one, everybody saw this move here, like, okay, let's go short the Russell because it's breaking down below the bear flag. That was a huge bear trap. This could be another bear trap as well too, but only if this breaks above 2000. So we got a lot of dynamics coming along, but also something that we mentioned, that the entire Russell 2000 is not even at the market cap of Apple by itself. So there's only so much that we're going to spend on that.
Yeah, if you go back, you can go back to the SPX too, and I see we've actually gone. We're almost back to even on the SPX, and then positive on the day on the NDX right now. So there's, again, this game of musical chairs continues. Somebody hit the buy button. We'll see what happens into close. We'll see how things close today. But
yeah, that's quite a round trip, because you can see that we were trading within the opening range, and then
there's your hammer.
So I had actually, this is one of the few days this year I've had no 0 DTE trades at all. Nothing.
Got Look at that, nothing, go back up into the zone.
Nothing to trade. So that is our daily chart here. So that's quite a move. That's quite a move. Okay, we got a question coming in from Brewhead here. If you wanted to make 3 cents on a spread per week with 500 contracts, oof. Boy, do you have the commissions to be able to support that?
The 3 cents.
Would you be better off using a 95% probability 1 or 0 DTE spread, or a lower probability farther out to catch the smaller relative move? Interesting.
Well, 500 times 3 cents is like $15. So is that really worth it? I mean,
well, that's 3 cents would be $3.
I'm just kidding.
So that's,
but that's, I mean, yeah. So you're looking at like a very small amount with that. I mean, honestly, you're better off doing the campaign trades. But we're doing the same. We're doing a similar thing. That, I mean, the 50-50 strategy that I've got in my service effectively is similar thing. We're going 2 weeks out. We're using the theta decay in our favor, and we're doing 10 by 5, delta, selling the spreads on those things, and we're sticking in for 50% on the credit, which equals about a 2% typically return on your risk. You just kind of put them on, let them go. We do them, multiple days a week, and they typically are on maybe 3-4 days and they're out. 3-4 days and they're out. So something like that works better. The biggest thing that you've got to contend with, even if you're going to do 500 contracts for $3, after trade costs, I hope, is it's the really the black swan. It's the big move down or the big move up that catches you in all those contracts. And then, all of a sudden what was $3 is $100 and you're stuck. So you got to time it really, really well. Now is probably not the time for that. If we're going to get a volatility event, that would be a horrible time to try something like that.
Yeah. And I think a lot of people, the first notion that, I mean, there is no difference. I mean, there is no difference actually between something which is way out of the money versus something which is way right at the money.
At the money.
Right.
Yep.
So what you'll find is that things happen faster at the money, and you're taking a much bigger credit. So it's a little bit, so it can be scarier. It can be more difficult, and it does take a little bit more skill to play these at the money versus out of the money. Out of the money is effectively, you're like, if you're serving on the Army, right, you're back in the artillery. So all you're doing is you're slapping shells into a rifled barrel and flinging them 5 miles, downrange. And as long as you got somebody that tell you where to fire at it and stuff like that, you're good. All you got to do. But if you're right on the front line, you got to be really, really good with your weapons, right? Because you're under
Yeah.
peril. So that you got to figure out where you are in the continuum of trading. The I hate to put it this way, but kind of the less skill that you have, you want to go further out of the money and make it a higher probability, worse reward to risk trade. But eventually what you want to do is you want to start to move towards the front lines. You eventually want to do that because that's where the speed happens. That's where you get better reward to risk. You're better able to control your risk on things, and it doesn't become like a 2 a.m. emotional check in the futures kind of like thing. So,
Yeah.
but just about any strategy can do something like that if you've got a way to make it repetitive and just kind of crank the wheel on it, and just, that's where you can get into big scaling as well too. But those are difficult. I've tried to do strategies like that where you're literally, what you're describing, Brewhead, is literally picking up nickels in front of the steamroller. Right?
Steamroller.
And it's just, you're picking up little nickels in there and you're trying not to get, run over.
Well, I mean, we can have a little fun experiment with it. 7 days out is February 12th. So you look at like the XSP, what would you need to sell? Let's just have a little fun. What would you need to sell to get $3? So let's take a look here on my side. So you would need to sell probably an iron condor. Probably if I play the XSP, let's see here. Trying to go in at like a 1 delta.
You doing 12 February?
Yeah, 12 February. Looking at like a 1 delta because that's pretty much where you're going to be at.
Oh, good Lord.
So let's see here.
Yeah, you're literally
460 on your downside.
You got to go. You can't do a 1 delta and cover the spread. So if you're going to get 4 cents, you're going to have to come up to something like
I'm looking to see. Yeah,
maybe
it's,
a 6
it's at
delta.
0. It's -6 at 1 delta. Let's see here.
So let's go.
I'm going 5 wide on these things to try to get something.
Okay, so we'll go 5 wide. 478, 483, you're getting 11 cents credit. And so something else that you can do, Brewhead, is like, just because you're getting 11 cents credit doesn't mean that you have to stay in for the full 11 cents, right? What you can do is look for a differential after you pay your commissions round trip, which is going to be a little bit more than you want for something like that.
That's what we do. That's what we do in the 50-50. Like this morning, my 50-50 trade was on Carvana, was out 2 weeks. I ended up getting $27 per contract. It was a 3 wide spread. The EVA. Yeah. EVA. All right. So I was out to 2 weeks, a little less, out to the 16th, and it was the 36 by 33. And I believe, let me see what the buyback is on that right now. 19 cents. So I got 27 cents, 19 cents. My halfway point sitting there at about 13, 14 cents. So a little bit more time burn. I'll be out of that thing. So that's a good example of how you can do this on another way to kind of accomplish what you're doing. Less contracts too. Doc, looks like there's a question for you on volatility.
We got Jam and Jeremy checking in. With the expected volatility event looming, let's see if we got, there we go. With the expected volatility event looming, is there a point where you stop putting on campaign diagonals? If so, do you switch to a different strategy during bear markets and pullbacks? Actually, if you think about it, there is, what I've been thinking about is a couple of different ways to change things around. And like, if I think that I'm entering at the bottom of a pullback with the implied volatility higher, that actually puts me a little bit at a disadvantage. And what I think I'm going to be doing during that time, now this is the opposite of what you're asking, but I think what I'm going to be doing during that time is going further in the money for my long put. So that's going to be a little bit of a cash hog, but it's going to be less susceptible to the volatility crush if I'm expecting a rally. Now, on the opposite side, I was thinking about this morning, actually, is like, what can I do to create an advantage to the downside? And we are already going out of the money on the long put, which I think gives us a little bit of an advantage, because as the price goes lower, as the volatility ticks up, that's where you want to be out of the money, actually, in a long option, that you're getting that explosion in value. So we're already doing that a little bit. I could go either further out, number one, go slightly further out and really press my advantage on something like that. Or number two, I could use a ratio. Now, this is only going to make sense if you're doing multiple contracts of this. Multiple contracts would be like if you're doing maybe 6 contracts on the XSP, and then what I could do is I'm selling 6, I could maybe buy 7. So it's a very slight ratio. And so I'd have to make sure that I'm doing that during very low volatility times. So there are things that I can do. I'm a little bit hesitant to go in there mucking around with something that's actually working very nicely for us right now. So,
well, one thing you could get back to doing if we really get a big volatility, it may be short-lived, may be able to do it for a few weeks, is the good old target 100s.
Oh, if we get back to an IV percentile of, 40%, 50%, things like that. If we get back to volatility, if we start to fly around the place and just, ugly volatility, and if we get, we get a VIX up to 25, 30, then yeah, we're going to be right back to we're going to be serving in the artillery again. We're going to be setting up the target 100s, a mile out of the money.
For those of you that don't know what those are, that's actually how we started with the live trading room, was around doing these daily 5-day trades, iron condors, big wide iron condors at the height of the volatility in the bear, where we were 200, 300 points out of the money on either side, picking up, about a 2 to 3% return every single day on these things, and just letting them go. Basically being out in a couple days with them hitting targets on these things. That's why we call them target 100, because if you can do the math, if you're getting effectively 2% a day, you can make 100% return on the money risk, right? So target 100. But it was like taking candy from a baby for a long time, until the volatility switched. And then it became really hard to do them, and we still got, we've got students in our mastermind and stuff that do them daily, but they are much more active to manage them and stuff in an environment like this, versus where you literally put it on and like a day or two later you're out and it hits target and there's nothing you need to do. So if we get an environment like that, those are a lot of fun.
So as you can see, we're always like, there is no, and this is a big revelation, I think, to a lot of traders, is like, you think you can, learn a strategy and then you're done for life. To some degree, I think the skills that you pick up are good for life. But probably the biggest skill that you can pick up is to sort of understand, what's the weather like in the market? What's happening? From a barometric versus altimeter versus temperature, and just what's happening with the shifts of everything. What are the dynamics of the market, and what are the edge? So yeah, time decay of an option is a basic edge that occurs no matter what happens, but you have to put it in the right context. If you're playing literally right on top of the price, which is what happens when you have a low volatility condition, it's not going to take much of a move before you get run over, and those are no fun. So we're always trying to find the right conditions for our strategies. Okay. Any
Yeah,
last
any final
questions?
questions?
Yeah, any last questions for anybody? And of course, for those of you watching on the replay, if you have any questions that you want us to bring up for next time, please let us know. Just drop us a note, support@12minutetrading.com. And with that, I think we're good. So from Dave and myself, we are 12-Minute Trading, and it's been our honor to host you guys once again, and we'll see you guys in the next session.
Thanks, everybody.
Thanks, everybody. You guys take care.